Welcome to a special Cybos edition of the Bankers Masterclass series, filmed here in Financial Times headquarters in Hong Kong. My name is Charlie Corbett. I'm the economics editor at The Banker. Today, I'm going to be talking to some senior Bank of New York Mellon specialists about the evolution and integration of treasury services across Europe, the Middle East, Africa, and Asia. First up are Al Briand, Global Head of Product Management for Treasury at BNY Mellon, and Michael McDonough, who is Global Head of Trade Products at BNY Mellon. How do you think clients' needs have changed recently, but particularly in the light of the global economic downturn?
Well, I think the global economic downturn changed a lot of things, and I think the key thing is that efficiency and the visibility of cash in the trade finance cycle became something from a nice to have to something that was urgently needed. And I think that there's been a lot of work between the corporate and the financial community to try to make this work. And there's a lot of drivers that I think have been out there that are enabling that visibility of cash in the cycle, including the technology that's available, some of the standards that are available out there. And I believe that both the banking community and the corporate community are looking outside traditional barriers in their organizations to be able to integrate at a much higher level.
Mike, would you agree that cash now has become king?
I think working capital and cash have become king. I think that corporate treasurers continue, despite the crisis, to focus on the need to make their operations more efficient, and they're looking to their core bankers to assist them in that. So banks are continuing to have to develop the systems and the technology and the product architecture, if you will, that will serve that ongoing need that the corporates have to continue to get efficiency out of their trade and cash and liquidity management services.
You both talked about technology, which when you combine that with the added regulation that is going to happen, both because of the mistakes that were made during the crisis, but also because of various regulations throughout Europe, such as SEPA and PSD, that kind of thing. Has this cost of the technology and complying with the regulation forced out a lot of smaller banks? And if so, what can they do to compete?
I think smaller banks have an opportunity. There is an investment to be made one way or the other, but there are options out there. And there are global banks, such as the Bank of New York Mellon, that can provide options to smaller banks to be able to serve their clients effectively and continue to offer first-rate technology.
So I would like, looking ahead now, to get both of your thoughts on how you think the market will evolve in the short to medium term, and how banks can who are going to be the winners and losers in this new environment.
We think that the type of global provider that has the combination of the trade finance, the supply chain capabilities, the payments infrastructure, in the long run will be a very solid and preferred provider in the industry.
I think that corporates are very much looking to wring as much cost out of their system as they possibly can. They're taking advantage right now of this turmoil in the market to try to do that. Banks who can step up and provide them the technology that they need, but as Al said, also provide them the one-stop shopping solution that they need, I think have a distinct advantage, especially in a time like this, and then carrying forward.
Are we out of the woods in terms of the global economic downturn? If I was one of your clients and I was coming to you and saying, what are my prospects? Are we out of the woods? Is this recession going to last much longer? What would your answer be?
We're not out of the woods. We have to be very careful going forward, and I think that's where a lot of the tools that we'll look to work with our clients over the coming months and years are going to be very important to ensure that there's visibility in cash, transparency to the process, and that the service is there for our clients in the long run.
I agree completely. The fact that the recession ending just means that the damage will stop getting worse. Clients and banks who serve those clients are going to have a number of issues to deal with, potentially for the next year or two, as things get resorted, as costs and other technological issues get sorted out in the different institutions. I think that banks and corporates that work with them are going to have a great deal to think about.
And do you think the competitive market's going to change within your industry? in terms of who you compete against and how these banks are going to evolve?
I think potentially. I think it depends upon how the clients are going to view their trusted partners and how many of them they will perceive there to be in the market. But I think that there certainly could be a reduction in supply, if you will, of services going forward in response to that.
I think there will be a reduction, but I think there's still opportunity for both large, medium, and small players to play a role in this industry, and I think we'll continue to see that happen because there are options in order to gain the capability to be of service to clients around the globe.
Great. Thank you very much. Now on to Europe, Middle East and Africa. We have with us now VERSCHOYLE-KING, who is Head of Treasury Services for EMEA, and DOMINIC, who's Head of Market Development for EMEA, for BNY Mellon. Firstly, how has business been in your region in the light of the economic downturn? How have your clients' needs changed?
I think they've changed, Charlie, in two ways. The first is that the emphasis has been much more on effective risk management than necessarily simply transactional management. And I think the second way is that clients are now viewing us much more as strategic partners and looking for longer-term business support rather than a one-off deal-related support. And in both ways, the market, frankly, has played to us in that time. So I would say overall we've come out quite well of what has undoubtedly been a difficult period.
Okay. And most of your clients, are these financial services clients or are these corporate clients as well?
In EMEA, our overwhelming focus is on financial services clients. So that is banks and other non-bank financial institutions. But what we have to remember is we need to look through our clients to their own customers to determine what the ground level need is, because that is ultimately the need that we service.
And what have their difficulties been? What have they been coming to you and saying?
I think, again, the dialogue has changed with clients. So what they've been saying is, you need to support us through a challenging time, challenging in terms of risk management, balance sheet management, and transactional management. And you also need to make sure that you support us in terms of providing infrastructure to allow us to provide products to our end clients, who are typically the corporates.
It seems to cost more and more to stay in this business, in transaction services. How can smaller banks compete now? Because they've got to pay for all the new technology, they've got to comply with all regulation, and particularly in Europe, there's many thousands of smaller financial institutions across the continent. How can they continue to service their clients?
It's undoubtedly challenging, and it's interesting that you mentioned specifically regulation, because I would actually say that's been the largest challenge over the past 2 or 3 years. Firstly, simply keeping up to date with what's required, and then secondly, building the infrastructure to support those requirements. To answer your question, there are many ways in which those smaller banks can meet the requirements of their clients. One of them is to attempt to build infrastructure and capabilities to support. But a second way is to work with other organisations so that the infrastructure is effectively delivered by partner banks.
Now that's interesting. Dominic, tell me, there's clearly a difference between outsourcing and partnering. I would say that if you bring in another bank, is there not a risk that bank, that bigger bank, could steal your clients, could affect the relationship that you have with your underlying clients, Dominic? Would you say that's...
Absolutely, and I'm glad you mention it, because I think it's a distinction that is perhaps not made overly clearly to the market. It's a distinction that we've been advocating, frankly, for some time, because there are institutions out there whose main business is serving corporate client needs in certain geographies. and inevitably they are going to design their systems, their technology, and their whole approach to that market will be focused on the needs of those core corporate customers. FI business for some of those institutions is, I would say, a bit of a bolt-on. It gives them volume and sometimes access to markets where they haven't necessarily been overly present. So those banks who are outsourcing rather than partnering to such global institutions, I think, do run the risk of being disintermediated, if not immediately, then over time. And we put a very clear distance at BNY Mellon between ourselves and that sort of institution, given that our focus is on helping service the financial institutions, service their clients. And I think that model has proven not only in terms of our recent success within the region to be a good one, but also is borne out in large part by an independent piece of research that we have recently run that has studied the sector in a certain amount of detail.
What's your single biggest concern for the next 12 to 18 months, and how is your strategy evolving to meet that concern?
Our biggest concern is to make sure that we serve our core client base properly, the financial institutions, bank and non-bank FIs around the Europe, Middle East and Africa region. We tend to find that in the research that we've done, we've become very much aware of what their underlying corporate clients require. Our concern is that, firstly, those banks, our clients, understand what their corporate clients require, and that, secondly, they know that we're there to help them provide those services to their corporates. So my concern would be making sure that they know that we're a partner that they can come and talk to.
Dominic, would you agree with that? Would you have anything to add?
In certain part, the problems that the financial community has faced as very apparently in the last 12 months, but I think that had its roots in issues and decisions that were made long before September 2008, is because there was there developed over a number of years a gap between corporate requirements and the banking community. I think that there was lost a focus at local level as to what the real underlying corporate need was. And the research that we've done absolutely brings that home to us, that local provision linked in with global infrastructure is absolutely the way forward, so that key decisions, particularly credit liquidity decisions, are being taken at local level, where the knowledge really lies, but being mapped into the sort of reach and infrastructure and technology know-how that an institution such as ours can deliver.
So it's all about bridging the gap between local needs and global issues, I suppose, the global side of banking.
Absolutely, but making sure that the local and regional banks remain the end providers to their clients. It's about working together, collaborating, and not disintermediating.
But without competing.
Absolutely.
Great. Thank you, guys.
Thank you.
Let's talk a little bit about Asia now. We're joined by Richard Brown, who's Head of Treasury Services in Asia for BNY Mellon, and ANEISH Kumar, who is Managing Director and Head of Treasury Services for the Indian subcontinent. Welcome, guys. First off, I'd like to ask you both what you think the impact of the downturn has been on Asia and your clients within Asia, their needs, as perhaps compared to the rest of the world. How have their needs differed? Richard?
It differs by country, but what we've seen is a continuation of the theme of looking for more efficiency. One of the things that's happened is that, frankly, a lot of companies have gone out of business. So what had been a long-term trend of looking for more efficiency, if anything, has been accelerated by the crisis. And what that has led to, in turn, is a drive for more integration of supply chain activities, including trade finance, cash management, working capital management. And corporates have been looking for that.
Sure. Aneish, is Asia, it's a much more fragmented market, isn't it, than some of the more developed markets? So obviously the impacts of downturn are going to be very, very different. Would you agree with that?
Well, yes, I would. In the sense that if you look at the Asian economies, the economies that's really been impacted are the ones that's actually been led by exports. There are a lot of countries, even something like India, where the dependency is far less. These have been less impacted as compared to the developed nations like Europe or US. Now, the recovery for these Asian economies are kind of little more quicker than the Western economies, basically because most of these Asian economies can spur domestic consumption to a larger extent.
Sure, sure. And in terms of the market dynamic, lots of small and medium-sized enterprises, how does a bank like BNY Mellon break into a market like Asia, which is clearly dependent on lots of smaller local banks? Richard?
You're exactly right. In Asia, one of the consistent themes is that corporates like using local banks. Part of that is because there tend to be a lot of corporates. You take a market like China, it tends to be many, many small companies that manufacture the goods. They're spread all over the country, and accordingly they need geographic coverage that foreign banks cannot provide to the same level as local banks. That's why our strategy is very much to work with local banks, to partner with them, rather than going directly to the corporates themselves.
I mean, this is an interesting question. How do you firstly build up trust with clients that perhaps have never heard of the brand BNY Mellon? How do you do that? How do you build that trust up?
Well, in the current economy, probably if someone would say that they haven't heard of BNY Mellon, well, I suspect that because today we are the only AAA rated bank in the world, and there's a lot of flight to quality that has happened in the last 6 to 7 months in the various lines of business that we run. So probably it's the media, it's the rating agencies who have put up our cars in a larger manner. So I think the most corporates, the medium sector as well as the larger sector, understand the existence of BNY Mellon.
Sure.
They are looking at clearly at partners who have global footprint, who have the product capabilities, who have the technology background to run their business. And precisely for that reason, I think the element of trust has been there with this bank because we also operate on a no-compete basis as regards to local banks are concerned. They like us, we like them.
Of course, I mean, and that's the bottom line. It's convincing them that you're not there to steal their clients, but
correct.
to offer them help in, I suppose, integrating all their commercial activities with cash management, payments, and
It's a collaborative model where typically we are providing the technology, most important of all, and against a need of to integrate cash and trade services. That technology is vital, but it's also very expensive. So for a local bank, typically beyond their means to develop themselves, and that's really our role to step in there and to provide it for them, to give them access globally to any market they choose around the world, and, as you say, not to compete with them.
sure.
I could add a little bit to that. Look at the new Basel II recommendations for capital outlay. I don't think many of the local banks would have the resources and time to develop this channel infrastructure. So the reason, or the right reason for them to have a strategic alliance is that more than anything else. They would definitely be looking at banks which are huge, which has infrastructure and a kind of supreme product capabilities to run their business in order to satisfy their own clients and to be in business.
because they simply can't afford to comply with all this new regulation themselves?
Apart from that, each of these markets have different regulatory structures and compliance mechanisms which only the international banks can supply to those local banks. And so the local banks who are local and the local banks who have global aspirations would definitely be trying to partner with the larger multinational banks.
I'd like you both to get your crystal balls out now and tell me how in the next 3 to 5 years, short to medium term, the market dynamic in Asia is going to change, i.e. the competitive landscape. Who are the winners? Who are going to be the winners and who are going to be the losers?
The key issue is whether local banks adopt technology that can integrate the various services. In our white paper, where we did some research on this topic, and the conclusion was where local banks have found ways of accessing the technology, then their corporates start to use it, are prepared to pay for it, and the level of sophistication increases. Where they've not accessed the technology, the risk is that foreign banks grow their market share. And we've already seen it to some extent in India, but to an even greater extent in Korea, where the void gets filled by the foreign banks. Our role is very much to work with the local banks to equip them so that that increase in share for the foreign banks doesn't happen.
And what would you say, just wrapping up now, what's the biggest lesson, do you think, that banks have learned as a result of the financial crisis? What lessons have they learned? Richard?
I would say if they want to grow their business, they have to listen to their clients as to what they need, not only to prosper, but in this climate, to survive. And that implies they need the technology to offer these kinds of services. And if local banks don't do that, the risk is that foreign banks step in and do it instead.
The dimension is the crisis is that people have taken a different way of looking at risk these days. Apart from the conventional risk, they are also looking at the geographical risk and the product risk, which was otherwise not known to many banks. So that's been the key lessons. The CFOs and the CEOs, when they try to rebuild the organization, the one thing that would change for them is the way they look at the risks, and more so the unconventional risk which they are not aware of at this point in time.
Great. Thank you very much. Thanks, guys.
A pleasure.